But when you look at a silver chart, it's hard to understand what caused that, because frankly, gold didn't collapse like that. It didn't go down into the 1600s, take out the lows of the last year and a half, but silver did.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics as we dig into the economic and silver market related events of our day. And certainly with so much of the pricing in silver being dominated by what happens in the futures contracts, it's quite exciting to have an expert that many of you are already familiar with, which is Michael Oliver of Momentum Structural Analysis, joining us on the show to talk silver and some of the latest economic developments, what to expect or look out for with the Fed. I guess for them aggressively raising interest rates 10 years too late. So late that even Ben Bernanke had a comment, which we will get to later on with Michael. Real quick, before we get started, a quick thank you to Sierra Madre Gold and Silver, who is bringing us today's show, and hopefully will be bringing us silver in the future, where the supply and demand fundamentals not lining up so easily. But with all that said, Michael, great to have you back on the show. Nice to see you again. Always appreciate your calm, wise presence in the midst of these markets that are quite chaotic. We have war tensions going by the day, so welcome on in. And how are you today, my friend?
I'm fine. I should have a black eye though. Silver. Okay. We analyze Momentum Structural Analysis for our subscribers, institutional and individuals, all four major asset categories. Yeah, the stock market here and elsewhere, the bond markets, foreign exchange, and commodities, with an emphasis on gold and silver. And of everything we've called this year, if I delineated it, you'd say, "Boy, that's a pretty good record." But the one that is really bad, we call the stock market right off the highs, major bear market, we said, and we think it's only begun, bond market, et cetera, et cetera. But silver's the one that surprised us. One, we think that silver going forward, and we think gold is in an ongoing bull market. It has paused, yes, for 1 3/4 years. Right now, gold's in the middle of that range. But silver, which had an explosion in 2020, which we got bullish, extremely bullish at $19.50 some odd cents, and it shot to 30 within 6 weeks. We thought, oh, that's good behavior. Okay, then it went into a congestion zone, much like gold did. Silver kept going down under $22. It did it 3 times. In fact, 6 or 7 weeks after the August 2020 high, which approached $30, it traded under 22. It was the first sell-off, was very sharp. And then from that September 2020 low, it rallied back up, and in January of 2021 was again at 30. Then it pulled back again in a slow, layered manner. Twice in 2021, mid-year and late in the year, it traded under that $22 level, second and third time. Same level that we'd reached in the summer of the September 2020 pullback. So there's 3 lows over the last year and a half where silver dips under 22 and somebody buys it. Dips under 22, somebody buys it. Third time, and that third time when it turned up, MSA put out a report saying if silver will close, will get up above a 2440 area. It was coming up from the 22 to 23, go over 2440. We thought that would get it going and shoot it back to the highs. Well, it shot it up to 2750 very rapidly. So we got a $3 rally. But then something happened, and that's when gold in March reached up to its old high again, 2070, actually took out that high a little bit that it saw in the summer of 2020. But silver didn't get back up to its highs, around 30. It said it was at 2750, and then you started this erosional pullback. When silver dropped back under 24 this year, actually under 23.90, several weeks back during this quarter, we said, uh-oh, the breakout that we thought we defined above 2440 based on quarterly momentum has been negated. Something's wrong. So about 50 cents below where we said get in, we said, uh-oh, this is not good. We had no idea it would come down and take out all the price lows of the last 2 years. I mean, all those 3 lows just below $22, somebody was buying there, somebody was buying there, somebody was buying there. You talk about conspiracy. Somebody was accumulating silver under 22. They stabbed it out. Last week, we dropped down to $20.40. So if somebody's looking at a price chart of silver, you'd say, oh, golly, the floor just came out. It's no good. Right now, we're back up to 21.75. So we're pushing back up toward that old floor, price chart floor. But when you look at a silver chart, it's hard to understand what caused that, because frankly, gold didn't collapse like that. It didn't go down into the 1600s, take out the lows of the last year and a half, but silver did. The stock market wasn't crashing. The stock market had a bad couple of weeks, but it was, double digits, 10% type drop, wasn't 30 some odd percent. So it wasn't a crash event. And yet silver trashed itself. Okay, either the trashing is valid or it's invalid. What do I mean by invalid? Get a silver price chart back to, say, 2015, when silver made a bear low along with gold, late 2015. And look at what happened in March of 2020 during that sell-off route that hit everything, stock market, gold, silver, the whole deal. Silver went down and blew out a similar floor that it had built since 2015 around the $14 level. In that March 2020 event, it blew out that price chart floor, stayed down there for several days. And next thing you knew, it's back up in the price zone that it lived in, and it took off. The low in that break was $11.50 area. Yep. It took out all those $14 lows. It was an invalid price chart sell signal. It aborted quickly. And next thing you knew, silver was recovered and on its way back up. We think this is a similar event, that what silver just did last week by blowing out that too obvious price floor. I say too obvious means any idiot looking at a price chart can see it. Therefore, it's pulling his hair out. Silver's no good. Well, it was no good in March of 2020, right? Not so. That was a bear trap. We think you just saw a bear trap. We don't have enough evidence yet in terms of upside turn that says, okay, it's over with, we're going back up. It won't take too much more. And so we're updating our subscribers when we see enough evidence that, in fact, silver has finished its vortex low, sort of a replica of March of 2020, and is ready to go back up. So that's our black eye of the year, silver. And yet it's the market that we frankly love the most in terms of its very, very long-term technicals, in terms of its relative pricing to other assets, such as silver price versus gold is at very low levels. In fact, if you go back in history of the last 5-10 years, you'll see we're at a level now where if you start to see a turn, you're coming off of a very good bargain level. And over the last few days, we've started to see a ratio turn between silver and gold, where gold is nudged up and silver has sort of shot up $1.50 or so. If that continues, then that's sort of affirming our sense that silver put itself into a bargain basement situation. But silver in relation to anything in the world, probably the price of cow manure, it's lower than it's ever been in relation to that. It's lower than it's been in relation to gold. Lower, it's very low in relation to the commodity complex. So either something's wrong with silver and it's no good anymore, thousands of years of value, like gold, held its value, or now it's trash, or that was a bear trap. And we go with the bear trap argument. And we think that once it demonstrates that it was a bear trap and it's reversing, you'll probably shoot back up again. And at that point, we expect silver to outpace gold on a percentage basis.
Yeah, you would certainly think so. And how do you factor in? I mean, we do have the Fed raising interest rates, at least for them, somewhat aggressively. So I could see that a lot of traders saying, all right, well, with them essentially unprinting some of the money, right, selling gold and silver. But yet, as you pointed out, I mean, we look at the positioning and some of these levels, at some point, the selling gets exhausted. It feels even like in silver world, there's some blood on the street. So has that been exhausted? What can we say about the degree of certainties to which we may have reached the bottom, or is there lower to go?
Broad stroke, we think you've probably seen the low, but we need to see a bit more upside over the next week or two to confirm that. But the issue about the Federal Reserve and monetary policy, we think is hot air. Okay, why? Everybody harkens back to Volcker. The raising rates, the gold collapsed. Okay, well, the fact is that we ran charts on this a week or so ago. We showed a Fed funds rate chart. I mean, we showed a gold chart from 1976 low through the 1980 high. Gold went from like just above $100 to 850, eightfold move, which is it's done 2 other times in the last 50 years. And I think this is probably the 4th time coming up. But anyway, all during that upward curve in gold, that 3.5-year bull market, stocks laid in at waste. They'd had a bear market in 74 and they rallied some into 75 and then just went dead through 1982. So we didn't have a stock bubble back then. But the Fed was raising rates, Fed funds rate. In fact, when Volcker was nominated in late 1979, already the Fed funds rate had gone from like 4% up to like 11 or 12% by the time he was nominated, which I think was September of 1979. And gold hit it during all those rate rises by the Fed from, like I said, from about tripling the rate from about 4% up to like 11 or 12 before Volcker even came in. Gold was still going up. It didn't care about Fed funds raising rates, nor did the commodity complex, which was following gold at that point. Gold led the commodities into that bull market. Volcker came in, he raised rates to 15% in late 1979. Gold was still exploding. In January of 1980, gold hit 850. In March of 1980, Volcker raised rates to 20% Fed funds rate. Gold had already peaked. So all during this upward curve and rate rise, and even once Volcker came in, gold said, I don't care. It was in a ballistic 8-fold move. So naturally, when you finally get up to 20%, gold had already peaked 2 months before, January of 1980, collapsed a couple $100, and he raised rates in March of 80. Commodities peaked in late 1980, but at least you had an 8-fold gold move and a huge commodity move, a bubble, so to speak. So that it made sense that when you raise rates, that asset category would finally say, okay, we've had our party. We've gone up 8-fold. We were due for a downturn anyway. And he provided a good excuse. It's totally reversed now. We don't have a commodity bubble. We don't have a gold bubble. Gold has only doubled since 2015 low. Only doubled. It's no big deal. Gold has had 3 moves in the last 50 years that constituted 7 to 8-fold increases in price. We've only doubled over the last 6-7 years. So it's hardly a bubble. And frankly, it's back to only where it was in 2011. Yep. 1920. So we exceeded that and we're hovering either side of it for the last year and a half. So gold isn't a bubble and commodities certainly aren't a bubble, even though they like to say, oh, they're overdone. If you look at the Bloomberg Commodity Index, and go back to 2008, 2011, we're not near those highs. Yes, the Bloomberg has had a massive percent move, but it's had a massive percent gain from an extremely depressed 5 years. 2016 through most of 2021, the Bloomberg was at levels that you just say, I can't believe it. It's like zero pricing for commodities as a basket. In October of 2020, we called, I meant to say 2020, not through 2021. In October 2020, we called for a commodity explosion based on technicals across the board. Sure enough, almost 9 out of 10 commodities exploded on a percent basis in unison. We think what that was simply that they had been depressed as an asset class for way too long, thereby suppressing production of those commodities on a relative basis. And they were set up for both a fundamental and a technical upturn. And there certainly was monetary policy to justify that, especially when Powell came in around May of 2020 and exploded the money supply. The excuse was the virus. Okay, fine. At that point, shortly after he started that, gold already had peaked at 2070 in the summer, July of 2020. So all during the further increase in money supply, gold didn't go up any further, but it already doubled. So gold is ahead of these events. We don't think it follows Fed policy. And here's the problem with the central bank now, as opposed to trying to compare it to the 70 6 through 1980 bull market in commodities, which bust. They're not a bubble. Gold's not a bubble. The bubble is the stock market. You look at an S&P chart since the 2009 low or a NASDAQ 100 through the highs of late last year, and you had a bubble you've never seen in the history of the US stock market, both in terms of years of upside, percent gain, and upward curvature. So this time around, the bubble that's going to break when the Fed shifts their policy or attempts to shift their policy is going to be an asset category that they can't allow to collapse.
Right.
Our opinion is in January and then in February, the NASDAQ 100 was over, S&P was over. We're entering a major bear market. And most bear markets don't crash. They're arm wrestling matches. Go back and look at the 2000 bull top to the 2002 low. Look at the 2007 peak to the 2009 low. And except for October of 2008, there wasn't anything like a crash. It was all 10, 15% drop, rally, 10, 15% rally. That's what the S&P has been doing since early this year. It's not crashed, nor is the NASDAQ. You've gone down a lot. And so have all the other asset categories. And that's the other problem the Fed has. Municipal bonds, which is a standard portfolio compartment, high yield corporate debt, junk bonds, give you high yield, right? Okay, so a lot of pension funds have plowed into those things because they get return. They can't get a return elsewhere. The Fed actually bought back in May and June of 2020 on through 2021. They bought muni bond ETFs, high yield corporate debt ETFs like HYG and J&K. They put them on their balance sheet. Literally, they were in there with you buying it, into the investors, okay, to bid them up. When the Fed quit buying those ETFs, like the summer of 2021, they didn't sell them, but they could just quit buying. Those markets peaked, and muni bonds and high yield corporate debt started down slowly, but distinctly opposite the S&P, which continued up through the end of 2021. But these markets, which had been in sync with the rise in the S&P, because the Fed was sponsoring them, as soon as the Fed ceased to sponsor, they started a bear trend. And we called the bear trend late last year in those asset categories. Okay, that's a problem. The Fed has a problem there because they can't let municipalities and state governments have funding problems. They can't yet let high yield corporate debt become a problem. That was a problem before, if you remember, back in 2009. So what the Fed has done, they've stuck a pin into a bubble, but it's the bubble they can't afford to break. And so we dare them to continue. I eat popcorn and drink beer and applaud when they try to do what they're doing, because I know that if they keep doing it, they're just going to exacerbate and speed up the collapse in their bubble, an asset category they cannot allow to collapse, and the other similar categories left and right of it, muni bonds and high yield corporate debt. The problem is for normal portfolio right now, if you look down the list of the categories you want to own, like look at real estate ETFs, as far as we're concerned, they're in a bear trend. They've been behaving highly negative, like they're down like 15% on the year. S&P's down, was down almost 20% at the low a week ago. NASDAQ was down like 26%. High yield corporate debt, muni bonds down big percent, double digit percent. So if you look at all the normal categories, including long government bonds, which used to be an alternative for investors to say, oh, golly, my portfolio, I got to put some money in T-bonds. That's been a disaster. So what are you left with? Okay, well, you look at gold, and right now gold is trading around unchanged on the year. Yes, it's well off the high we made in March, but it closed last year in the 1820s. Okay, yeah, it's given back gains, but when you look at all the asset categories, including that one, which is considered a legitimate alternative, though most people don't like to opt for it, it's the only thing unchanged on the year. So pants down, it's beating the other markets, all the other so-called legitimate asset categories. Gold is the only one that's the standout. It's unchanged on the year. Wouldn't you like to be unchanged on the year compared to the other guy? You know, that's a recognition that we see, and I think a lot of large asset managers see it too. Guys like Ray Dalio and so forth, who spoken pretty negatively about popular sentiment For example, Dalio said, it's like 6 months ago, he says, quit looking at the price of your stock. You know, it doesn't mean too much because the value, look instead at the value of your money that stock is measured by. It's depreciating rapidly. He used the phrase cash is trash. So that other asset category you might shift into when you don't like stocks, it's not behaving well either. It's losing extremely rapidly, losing buying value. So you're left with only one broad category. Gold, which is unchanged from the year, and silver, which just got trashed. Was the trash the beginning of something or the end of something for silver? We think it was the end of something and it's going to slingshot back up. We need to see some more metrics, but that's our thought process. And therefore, this Fed policy issue is exactly the opposite of what you think about, you remember about the Volcker situation. They had a commodity bubble then, they had a gold bubble. They were due for a downside. Therefore, when he raised rates off the page, they finally broke. Well, eightfold move of gold, fine, no big deal. We don't have that situation now. Instead, the bubble is not what he thinks. He's trying to break the commodity complex. And if you look at the Bloomberg, it just keeps going up and up. It rotates from oil. It's going to be grains this summer. We're going to take the lead. We think sugar is going to be quite a star. We think in the energy complex, instead of oil, you should be looking at natural gas. Natural gas is vastly underpriced in relation to most other energy sources. So it's behaving like it's now $8-9. You could see it go up to, possibly double that. But the commodity complex is not over. It's not a bubble. It's got a lot more to go. And I think what we're going to see this year, instead of energy being the issue going forward, it's going to be food. And when you deal with that concept, you deal with the issue of food, you deal with deep emotions that impact a lot of things. And the Fed is not going to stop the upside in grains, in most agricultural commodities. There's problems globally on that are disastrous right now. Give you an idea of how disastrous it could be. First off, if you get any adverse weather this year, and you're already getting adverse weather in some parts of the globe, but in the US, which as we know, the planting has already occurred in most of the crops, corn, soybeans, and wheat, and we start to see them grow through the summer, harvest in the fall. But the planting intentions report that came out at the end of March, which is just prior to actual farmers planting most of these crops, was horrible. You've seen a doubling and more in the price of these grains, soybeans, corn, and wheat over the last year or so, more than a doubling. You would think that farmers would go crazy to plant more, right? No. One of the crop planting intentions was up 4%, one was down 4%, one was up 1%. Net no change in the planting intentions of those three major crops. Goodness gracious, if you get any weather problems, we'll join in the problem that's coming from Europe right now, that's starving part of Northern Africa, the Mideast, getting political instability in the Mideast because of lack of food, riots in Iran, riots in Syria, Asia. India just cut off wheat exports. It's one of the biggest wheat producers in the world. Said, no more, we're keeping it indoors, we're keeping it in our borders because we're going to have a food problem. So the next crisis is food. And if you remember back what happened during the COVID situation, when you went to Costco and you tried to buy paper products, toilet paper, paper towels, there were even times when they rationed it, where you could only buy one bundle of paper towels per customer. Remember that? So people who never went through hoarding in their life, never had an experience, they suddenly learned how to hoard. Well, what if that happens with some food products? And I don't mean just baby foods. I'm talking about everyday foods for everybody. The psyche, what'll happen there psychologically in terms of consumer attitudes about things in general, safety, food, is going to change dramatically. It could become highly emotional and highly realistic. It's not unjustified. We've got a problem. And it has only just begun. So as Powell tries to stop that, he's wasting his time. All he's going to do is bust his bubbles. And then we'll see how long they continue with their so-called policy.
It's tough to sit there and watch, especially, I left the US, but caring about a lot of people who are there, and you see this set of banking and political policies. It's almost like you have the Fed on one side, and then in the court of the commodity sector, there is Putin and Russia on the other side who are talking about, more permanent gold backing and other commodities. So a lot going on there, and I sure appreciate you breaking it down for us today, Michael. Before we wrap up, perhaps you could let folks know where they can stay updated. Certainly a lot changes quickly in these markets, and could you let them know your website and what you offer there, so especially the people who are looking for the technicals know how to find you?
Sure. It's Oliver MSA for Momentum Structural Analysis, olivermsa.com. And go on site and explore, our background. We've been around 30 years, what our methodology is, why it's different, and request some samples. Be happy to send them to you.
Well, I appreciate that. We have the link in the description field below, and especially I like going through your silver and gold comments, because I don't know, at least what I focus on these days is a bit more of the fundamental economic picture, yet we see how this stuff is priced by what's happening in these contracts. So it's really great to have you on here and to have access to the research you're doing. And Michael, I just hope you're staying well and safe out there, and appreciate you being a voice of reason, and we'll look forward to doing this again soon.
Thanks, Chris.
Thank you again, Michael. I do appreciate getting that more technical perspective on the show. It's not something that I focus on as much myself, so nice to have that compliment of Michael. I know we always have a lot of requests for Michael on, so always a fun guy to catch up with. One quick story that I don't know if many people saw last week. I was a little surprised to see this myself. I try to stay away from the politics to whatever degree possible. Unfortunately, I think it prices a lot of today's markets, as we've been discussing throughout the show, and just seemed odd to me that in the middle of the Ukraine war, Jen Psaki, who has often offered to circle back on many key questions, I don't believe she's ever commented on the silver market, shockingly enough, but she has stepped down as the White House press secretary. Some of the articles say that she's leaving to spend time with her children, which, of course, wish you best of luck on that. Just seemed odd. You kind of know that before you go into a position like that. So whether that's a sign of turmoil or disagreement, I can't imagine what the politics are like inside the White House right now, but just passing along the news that Jen Circleback Psaki has left the White House. So we'll see how things go. And I guess I shouldn't be laughing. It's just overall very unfortunate to me what I see this administration doing. And for some of the critics I had on Twitter who were upset about that, wondering if I was a grand old party supporter or taking sides, I just think the whole political banking establishment is not doing good things in people's lives, and wish we had more of a free market. So not taking sides on either team, yet when you see what's happening with Russia and Ukraine and the US, a lot of politics involved. So anyway, that is a piece of news. And before we wrap up, would like to thank Sierra Madre Gold and Silver Exploration and Development Company in Tepic, which is near where I was last year in Puerto Vallarta. Now I'm on the East Coast, but fortunately last time I had a call with Alex. He gave us a nice little rundown of what they've been doing. I know we have a lot of gold and silver stock investors who watch this show. So for a quick recap, here you go from Alex Langer of Sierra Madre Gold and Silver. Alex, for people who are wondering what is Sierra Madre Gold and Silver, could you give them a quick rundown of what you're doing?
Yeah, absolutely. Sierra Madre Gold and Silver is an exploration and future development company, and we're focused on acquiring high value and quick through production precious metal assets in Nayarit in Western Mexico. Our 2 to 3 year goal is to have 50 to 100 million ounces of silver in inventory, as well as production, utilizing a centralized facility, something like a hub and spoke mining scenario, lower cost to start, but can grow as new projects come online.
So that is Alex Langer of Sierra Madre Gold and Silver. And certainly, should we get the environment that I've expected, that Michael Oliver was just describing, that's the type of project that has the potential to do very well. Obviously, there are many risks to silver stock investing. So go check out their website and just, if nothing else, start learning about the silver mining business before investing. But again, when you look at that profile, I think it's certainly something worth exploring. But again, make sure you're doing what is appropriate for you. But would like to thank Alex for bringing us tonight's episode of the show. And if you're still wondering whether we've seen a bottom in the silver market like Michael talked about today, well, why don't you hear what Craig Hemke of TF Metals had to say about it yesterday?